Welcome, fellow travelers of the cosmos, to a deep dive into the fascinating world where mathematics meets economics. Today we'll explore how math forms the backbone of economic theories and models, revealing the elegant equations that govern the flow of resources, the ebb and flow of markets, and the decisions we make as individuals and societies. Imagine trying to build a skyscraper without a foundation. You'd be in for a disaster, right? Well, the same goes for economics. Take supply and demand curves, for example. These iconic graphs with their intersecting lines aren't just pretty pictures. They're visual representations of mathematical formulas that describe the relationship between the price of a good or service and the quantity people are willing to buy and sell. And then there's equilibrium, that sweet spot where supply and demand meet, setting the market price. Elasticity, a measure of how sensitive one variable is to changes in another, is another cornerstone of economics that relies heavily on mathematical formulas. It helps us understand how consumers and producers respond to changes in price, income, or other economic factors. Core economic models, like the Cobb-Douglas production function, use calculus and algebra to model the relationship between inputs like labor and capital and the outputs they produce. Mathematics provides the very foundation upon which the edifice of economics is built. In the world of economics, we're not just dealing with abstract concepts and theories, we're dealing with real-world data, hard numbers that tell the story of how economies are performing. Econometrics, a branch of economics that uses statistical methods to analyze economic data, is like the detective of the economics world. It uses regression analysis, a statistical technique that allows us to examine the relationship between two or more variables to uncover hidden patterns and relationships in data. Econometrics also allows us to make predictions about the future, to forecast economic trends with a certain degree of accuracy. Key economic indicators like GDP growth rates, inflation and unemployment rates are the result of complex mathematical calculations and modeling. These provide us with a snapshot of an economy's health. Mathematics plays a crucial role in crunching the numbers, providing us with insights and predictions that shape our understanding of the economic landscape. Let's face it, we live in a world of limited resources and unlimited wants. We're constantly making choices, trying to make the most of what we have. Think about businesses, for example. They're always striving to maximize profits and minimize costs. This involves solving complex optimization problems using mathematical tools like calculus and linear algebra. Imagine a company trying to determine the optimal level of production to maximize its profits. Consumers too are optimizers, even if they don't realize it. They're trying to maximize their utility, which is economists speak for satisfaction or happiness, given their budget constraints. Utility maximization and cost minimization are two sides of the same coin, both relying heavily on mathematical tools like derivatives. Life is full of strategic interactions. We're constantly making decisions in the face of uncertainty, knowing that our choices affect and are affected by the choices of others. This is where game theory comes in, a branch of mathematics that's all about understanding strategic decision-making. In the realm of economics, game theory is an indispensable tool. It allows us to model and analyze situations where the outcome depends on the actions of multiple decision-makers, whether those decision-makers are individuals, firms, or even entire countries. Think about auctions, for example. Each bidder has to decide how much to bid, knowing that their bid not only needs to be higher than other bidders, but also low enough to ensure a profit if they win. Pricing strategies are another area where game theory shines. Game theory helps us understand the art of bargaining, providing insights into the incentives and strategies of different players. The world of finance can seem like a chaotic and unpredictable place, with stock prices fluctuating wildly and complex financial instruments being traded at lightning speed. But beneath the surface of this apparent chaos lies a bedrock of mathematical models that help us make sense of it all. Financial economics is a branch of economics that specifically focuses on the role of financial markets in the economy. Take derivative pricing, for example. Derivatives are financial instruments whose value is derived from an underlying asset, like a stock or a bond. Pricing these complex instruments requires sophisticated mathematical models, like the famous Black-Scholes model. Risk management is another area where mathematics plays a crucial role. Financial institutions use mathematical models to assess and manage risk, from credit risk to market risk to operational risk. Portfolio optimization techniques help investors find the optimal mix of assets to achieve their desired level of return while minimizing their risk. Economics is often divided into two main branches: microeconomics, which focuses on the behavior of individual agents like consumers and firms, and macroeconomics, which takes a bird's-eye view, examining the economy as a whole. In microeconomics, we use mathematical models to understand consumer behavior, how they make choices about what to buy given their limited budgets. We use it to analyze firm behavior, how they decide how much to produce and at what price to maximize their profits. Macroeconomics deals with the big picture stuff: economic growth, inflation, unemployment, and government policies designed to influence these factors. Want to understand how changes in interest rates affect investment and ultimately economic growth? We need mathematical models for that. Whether we're zooming in on the behavior of individuals and firms or zooming out to look at the entire economy, mathematics provides the lens through which we view and analyze the economic world. For those who truly want to explore the depths of economic theory and analysis, there's a special branch of economics waiting to welcome you with open arms: mathematical economics. This is where the true magic happens, where the elegant tools of mathematics are used to unlock the secrets of economic behavior. Mathematical economics is not for the faint of heart. It's where the rubber meets the road, where abstract economic theories are translated into rigorous mathematical models. Imagine trying to optimize the allocation of resources in a planned economy, ensuring that production and consumption are balanced. Or picture analyzing the dynamics of economic growth over time, taking into account factors like capital accumulation, technological progress, and population growth. Mathematical economics is the engine room of economic research, providing the theoretical underpinnings for many of the models and insights used in other branches of economics. In the world of economics, it's not enough to just come up with elegant theories and build sophisticated models. We need to test those theories to see if they hold up in the face of real-world data. Empirical economics is all about using data to answer economic questions, to test hypotheses, and to quantify the relationships between different economic variables. Regression analysis, our trusty statistical tool, takes center stage once again, allowing us to estimate the causal relationship between variables, controlling for other factors that might influence the outcome. Want to know the impact of education on wages? Regression analysis can help us isolate that effect, holding other factors like experience and occupation constant. Hypothesis testing is another cornerstone of empirical economics. It allows us to determine whether there's enough statistical evidence to support or reject a particular economic theory or claim. Probability theory provides the tools to make predictions based on historical data and economic models. As we've seen, mathematics is not just a tool, but a fundamental language of economics. It's the key that unlocks the secrets of economic theory, the foundation upon which sound economic policy is built, and the engine that drives innovation in the field. Thank you for joining us on this journey through the mathematical landscape of economics. Stay curious and keep exploring.